What if I told you a boring software company found a glitch in the financial system to keep buying Bitcoin and on a massive risk? Today, that company holds billions in Bitcoin, and that's more than 3% of all Bitcoin that will ever exist, and quietly becoming more powerful than most banks. And here's the truth nobody tells you. This entire strategy is built on leverage. So is this the greatest trade in history or ticking time bomb? Back in 2020, CEO Michael Saylor looked at his company's $500 million in cash and realized it was melting due to inflation. He called it a melting ice cube. Most CEOs buy back their own stocks or pay dividends. Saylor did the unthinkable. He traded the ice for digital gold. He went all in.
Bitcoin, there is no second best.
But he didn't stop at his own cash. Here's where the strategy gets serious. Saylor realized he could borrow billions of dollars from Wall Street at extremely low rates and uses that money to buy even more Bitcoin. Here's how it works. He issues convertible debts. He uses that borrowed cash to buy more Bitcoin. As Bitcoin goes up, the value of the company goes up. That pushes the stock higher and gives him access to even more capital. The result? He's using other people's money to accumulate Bitcoin. But here's the part most people miss. Why would investors give them that money in the first place? Because in return, they get paid through preferred shares and structured products. Some of these investors are earning around 10%, even over 11%, just to fund these Bitcoin purchases. So now think about it. You have investors earning income while the company uses that money to keep buying Bitcoin. They're not buying occasionally. They're buying constantly and at scale. And you can see it in the news. These buys are reported almost every week.
Strategy continuing its Bitcoin buying spree, acquiring $2.1 billion worth of the cryptocurrency last week. This as the company's shares have fallen by nearly 60% in the last year.
In 2026 alone, they've already bought tens of thousands of Bitcoin. That includes a single purchase of more than $1.5 billion. And they are still buying. So why not just buy Bitcoin directly? Simple. Leverage. When Bitcoin goes up 10%, MSTR can move much more. It's Bitcoin on steroid. But there is a massive catch. If you hold Bitcoin, you just hold the asset. No deadlines, no debts, no creditors. You can hold it for 100 years if you want. MicroStrategy is different. It holds obligations, it has creditors, and it has debts maturing in 2027, 2028, 2029. So what's happening if Bitcoin crashes? A lot of critics scream margin call, but that's not really the main issue here. Saylor didn't structure this like a normal short-term loan. Most of it's long-term corporate debt. The bigger risk is dilution. If things go wrong, the company may need to issue more shares to raise cash. And when that happens, your piece of the pie gets smaller. That's the trade-off. Bitcoin gives you the asset, MicroStrategy gives you amplified exposure to the asset, but with extra layer of risk. And that's why this is bigger than just one company. Saylor isn't just betting on Bitcoins, he's betting against the US dollar and on a future where the rarest asset wins. MicroStrategy is no longer just a software company, it became something else entirely, a Bitcoin vault built on financial engineering. And the craziest part, other companies are now copying this exact playbook. Now I want to hear from you. Do you think this is the smartest Bitcoin strategy ever created, or just a system that works until it doesn't? I'm Lamia, thanks for watching, and if you enjoyed this, don't forget to like and subscribe, follow us on X and join our Telegram community. Thanks for watching, and I'll see you in the next one.